like it came in an instant. Yo, what's the word, y'all? I ain't gonna lie. I really been supposed to make a video, but I definitely been bullshitting. But we back, man. And today is day 5. I ain't gonna lie, I be losing track, bro. I'm gonna keep it real. But I definitely think today is day 5. You know, last time we talked about like every app you needed to trade. Go watch day 4 if you don't have any trading websites, any trading apps. Go watch day 4. I gave like multiple apps that you can use in order to trade, so that as you watch these videos, you can be demo trading on your other phone or whatever on another screen, or you can be on a front end account, whatever you decide to do, right? That way, whenever you're watching these videos, you can actually keep up with what I'm saying and not just listening to me talk. Right? And another thing I talked about in the last video was my long-term investing portfolio, which was on Webull. And I'm not going to get into that today because y'all know the purpose for these videos is for me to break down the trading basics for y'all so that y'all can start going ahead and get to day trading. I don't get into my strategy or whatever, but I do give out the basics of trading, you know? So that's the purpose of these videos, so y'all can understand what candles are, liquidity is, breaking structure. This is the simple things that everyone needs to know in order to be a trader. But yeah, like I was saying, my last video I was talking about my long-term portfolio. I'm not gonna get into it, but if you want to know more about long-term investing aside from day trading, because this channel is more for day trading and breaking that down. But if you want me to do more long-term investing videos, then y'all let me know in the comments so I can get into that. And I'll break down my full portfolio in a full like guide of Webull, because in the last video I didn't really do that. I just did like a little preview of, you know, I day trade, but aside from day trading, I'm always investing long-term, you know, for the future. So yeah, if you want to know more about long-term investing, just let me know in the comments and we'll get into that in the next video probably. I don't know. But today we're going to be talking about liquidity. And liquidity is actually something that a lot of people struggle with, but it's actually one of the easiest things to, like, once you understand it, you will understand. But it is something, when I first got into trading, it was kind of hard for me to understand liquidity as well. Just because liquidity isn't something that you can just see. Well, you can see it, but it's not something that's like, you know, it's not a candlestick or something. So it's something you have to know that it's there. You have to know that when liquidity have just been grabbed or whatever the situation may be, right? But for starters, what I was gonna say, I don't know. We're gonna get into it though. So, for starters, this actually can be a form of liquidity right here. And we can see if it's actually a actual liquidity grab. But for starters, y'all know what candle means. Y'all know what the candle means. Y'all know what the wicks mean, right? So for the people who have not watched my previous videos the other days, go watch them so you can actually fully understand the stuff that I'm talking about. But for a preview, the candles is, you know, these red candles is whenever price is going down. These are bearish candles. Price open at this point right here, then it closed at this point. But the wicks of these candles is how far price went before it closed, right? How far price went upward before it closed, and this is how far price went downwards before it closed. But this is where price opened at. This is the body, and this is where price closed. This little body, that is the opening, that is the closing for these downward candles, for these bearish candles, right? Now, for these green bullish candles, it's the opposite. Price open here, during the on the body, and then it pushes up and it closes right here, right? But these wicks show where price went as that candle was open. So price opened here and price went down. This is the furthest it went. It didn't close there. It came back up and then it closed. Well, it went up a little bit and then it closed here, right? So these wicks just showing us where price went, where these candles went before they closed. So for the people who listening, what do you think about this candle right here? What does this candle tell you? Where's the opening? Where's the closing? Where's the furthest? Or where did this candle go? This candle specifically, right? So As I know, if you don't know, this is a doji candle. Write this in your notes. Doji candles. I'm not sure if I went over this yet, but doji candles are candles that have a small body but long wick to the upside or the downside, right? And we could find another. This will be another example of a doji candle. It has a long wick to the downside or the upside with a small body, right? So specifically this candle, it's an indecision in the market, right? Really, doji candles are indecision in the market. Indecision in the market just means we have no idea who's in control at the moment, right? We don't know who's in control. It could be buyers or sellers, especially when we have a doji candle that looks like this. It has a body in the middle of, the candle, and it has a long wick to the upside or the downside. So at this point, we don't know which side is actually rejecting, right? So when you see these long candles to the downside and price comes down here but don't close there, it pushes back up, that's telling us that price was rejecting that downside, right? Because price opened here, it pushes down all the way here, but it did not close. It came all the way back up here and it closed here. So that's showing us that it does not want to go to that downside. It came right here. If it wanted to go to the downside, it would have came down here and it would have closed right here at the lowest point that it went. But it did not do that. Price came back up and it closed all the way up here, showing that sellers tried to get in control right here, but buyers came back in and pushed the market up and continued to hold that uptrend structure, or that, that bullish structure. So that's all it is. Whenever you see these long wicks to the downside, that means price is rejecting the downside. And as you can see, you will see long wicks to the downside whenever price is already in the uptrend. So that's showing us that, price wants to continue to reject that downside area. And when you see long wicks to the upside, that just means price is rejecting that upside area. Just how we see right here. Price is rejecting the upside now because, as you can see, this is a very, very small body, but it is here, right? So price basically opened right here. This was a big candle at a point, right? Price opened right here. Price came all the way up here, but it did not stay. Instead of staying, sellers came in and put up a fight with the buyers, and they pushed it all the way back right here at the same point where price opened, right? So when it looks like this just means this candle closed at the same point that it opened, right? When it doesn't have a body, that's just all it means. Price closed at the same price closed at the same point that it opened, right? But specifically these candles, these wicks, which is what I'm talking about, this is rejection. This is showing rejection to the upside, right? A long wick to the upside is showing rejection to the upside, meaning it's showing rejection to that uptrend. And as you can see, right after we get the candle, all hell broke loose, right? So you just want to make sure that you're able to identify these certain signals, certain signs, especially when we are on these higher time frames. Right now, when you see candles like this on a lower time frames, I'm not going to say that they don't mean anything, but they're not as powerful as these higher time frames. If you see this type of candle on an hourly or 4-hour time frame and you are in longs, you might want to get out, bro. And trader experience, like people who are trading, if they were in a long, meaning they said the price was going to go up, then they would have saw this candle and got out. Because like as a trader, you have to know what certain candles mean. Even though I don't trade candles, bro, I don't trade based off candles. I trade off of market structure, what the market is giving. But this is market structure, right? If price comes all the way right here, and instead of holding right here, it closes all the way right here, I can almost assume that price is rejecting that upside. Like it doesn't want to continue to go up. And now as we can see, price continues to drop, right? So I'm going into this specifically because we are talking about liquidity today. And liquidity is basically these long wicks, honestly. Sometimes, I'm not going to even say that because I don't want to confuse y'all, because it doesn't always have to be long wicks. Like, liquidity could be grabbed with smaller wicks, whatever the situation may be. But to keep it short and simple, liquidity is resting above lows and highs, right? So whenever we are entering a trade, we have a take profit point and we have a stop loss, right? A take profit point is basically the area where you say price is going to, your target, where your reward is at, the money you're trying to grab. And your stop loss will be how much you are risking you know, when price hit this point, you automatically get out of your trade. Your stop loss is basically how much you're risking, how much you're willing to lose, right? So remember, like I said, stop losses. I'm sorry. Not stop losses. Liquidity is resting above highs, which will be right here. This is a high. And below lows, which is right here. This is a low, right? And it's a lot of highs and lows on this market, right? So liquidity rests above highs, right? And below lows. Because depending on which direction you are trading, if you're taking longs or short, and if you do not know, longs in day trading or in a market in general, longs mean you are buying, prices going up. You think, you know, prices going up, you're taking a long, right? Upwards. Shorts mean you are selling. You say that price is going downwards, you know, you say price is in a downtrend, you know, you're selling. You're making money on the sales, so you took a short. You're making money on the buys, so you took a long, right? So keep that in mind. Not sure if that's something y'all want to write down, but yeah. But liquidity rests above highs and below lows. Above highs and below lows, right? Above highs and below lows. I'm picking certain areas to mark out, but it's literally this a high, this a low. So literally above highs and below lows, right? That is where liquidity lies. So you can't see it, but you just have to know that it's there. Right? Okay. So, let me see how I get this off. All right, boom. Now that we know where liquidity lies. Hold on. Now that we know where liquidity lies, I'm going to give you an example on why you need to know where it lies so you can be on the lookout for it, right? So, whenever we're trading off the rip, we are aiming for these previous highs or these previous lows, right? Like, that is literally our target. And I'm going to go to another one. Just so it's clear so y'all can see what I mean by these target points, which will also be labeled as key levels, where I labeled it as key levels. I want to go to something that's kind of, let's see if silver. Okay, let's go to the hourly. All right. So, yeah. Okay. So, whenever we are trading, we are looking for, like, how do I explain it? Whenever we are trading, we need to know where we feel like price is going next, right? Where we feel like price is going next and where we feel like price should not come below to know that, like, we should not be in a trade or whatever. This is kind of hard to explain, but I'm going to try my best to explain it like that, right? But whenever we are targeting certain points, we target the most previous highs, right? Especially if we're saying we're taking longs, it's moving in an uptrend, we want to target these most previous highs, right? So if I was in a trade right now and I entered here, my next target point will be right here, these previous highs, right? A lot of the times I put it at the body because you will see a lot of the times in trading that price will come all the way to the body, but it would not come all the way to the wick of that candle, which is why I don't always have my take profit point at these at the wicks of my target. I have it at the body of the target, which will be right here at the body, right? And then price has broken up above this key level that, you know, we're just going to say this is our key level, this line. Price has broken above this line. Now that we have a key level, we will want to go down to one of these smaller time frames and see the most previous low. Pay attention to what I'm doing, y'all, because me doing it is the best way that I can explain it. It's hard for me to explain, like, you know, okay? So, when we are targeting points, we come to this hourly, right? Because that's what we mainly on. We are on the hourly time frame. So, we're taking longs. We target that previous high. That is our new target point, right? That is a target point, that previous high. We use those highs as our target, lows as our targets if we're taking shorts, right? So, since we are taking longs, these highs is going to be our target. And for our stop loss, what we want to do is scale down to a smaller time frame. Now, the only reason we are scaling down to a smaller time frame is because there are no lows right here that's in reach. It has to be equal. This is not a good risk to reward. Obviously, this big ass red, this red part is basically how much I'm risking, and the green part is basically my reward. So this is not a good risk to reward, right? We want to have this even out, or we want the green part to be bigger than the red part, right? But yeah, so as you can see, the low will be right here, right? We put our stop loss on the lows and our take profit above highs, right? I guess that make it a little more sense when I say it like that. So take profit above these highs at these previous highs and stop loss at those previous lows. But again, as you can see, this previous low is all the way down here, and we can't risk all of that just to get this reward, right? So what we want to do is scale down to a smaller time frame, and we want to get the most recent low that was still under this breakout point, which is our key level, which is still under this key level, because now, and this is something I'm going to get into in another video, now that price broke over above our key level, which is this black line, price should no longer come back under this point, meaning I feel comfortable with now making this low my stop loss, right? And even here, you can see that it's still I'm still risking more than I'm gaining, right? So we want to have it to where it's even. So even at that point, I will move my stop loss to the high of that low instead of the low of this low, if that makes sense. But as you can see, now this is a better risk to reward. Now I feel more comfortable. Now I am now gaining more than I'm risking if this price were to go wrong, if, you know, whatever the situation may be. So this is how we would do it, right? This is how we would do it. Boom. The reason I explain this life is because a lot of people who are trading is going to do it exactly like this. This is exactly how a lot of people will have their setup. And bro, it's $1 trillion this is $1 trillion business, right? This is $1 trillion business, and it's a million people who's doing the same exact little setup right here, right? Boom. Listen carefully when I'm speaking, right? So now that it's a lot of people doing the same exact setup, it's like the market. I'm not gonna say the market makers know, bro, but I feel like they know, bro. Cause I swear I be feeling like the market makers be coming for my stop loss, bro. I ain't gonna lie, but you know. I feel like the market makers know, but they claim they don't know where our stop losses are. So they say liquidity isn't real, but it's real, bro. All right, boom. Enough of that shit. But what I was talking about. All right, so boom. Our target above these highs, our stop loss below these lows. Let me break it down so y'all can see where I had these points. This is the low where I had it. It's above this low. Right there. Above that low. Oh, I'm sorry. It's right here at that. Right? So these are my 2 points in, you know, why this box is here. Right? So the example of liquidity I wanted to show y'all is whenever a lot of the times this is what price would do, right? A lot of the time this is what price would do. Boom, you entered right here, right? This is your target, this is your stop loss, right? This is how much you want to gain. This is what you're aiming for. This is your risk. So whenever price get to the bottom of this red box, you are automatically out of a trade. So whenever y'all do get into day trading, y'all actually start hopping on these trades, you will see that you're able to have a take profit line, meaning whenever price hits that line, you automatically get out the trade and you take your money. And the same goes for a stop loss line, right? You'll enter here, and then you'll be able to move your take profit line here. And whenever price reaches your take profit line, you automatically hit and you get out of the trade automatically, even without you being there, right? And the same for stop loss. You enter here, you put your stop loss line down here, and if price do decide to come down to your line, you automatically get out the trade and you lose your money without you having to be in front of the computer and manually like getting out of the trade yourself, right? Whenever you have these certain lines and points. Boom. So I say all that to say that this is your take profit line and this is your stop loss line. I'm sorry, I gotta go into details because this is I'm trying to explain liquidity in the best way for y'all to understand. I really hope y'all understand after this video. But yeah. So a lot of the times, as you trade, you will see that, okay, prices looking like it's moving right in my direction. It has broke above these previous highs right here. So this is looking good. This is looking like a good time to take loans, a good time to buy. Boom. You decide to buy, right? You decide to buy right here. A lot of the times what market would do is this. Let me give y'all boxes, because a lot of times what market would do is they would have a candle. Price will come here, right? Price is moving in your direction. We got a candle right there. Price continues to move in your direction. We get a candle right there, right? Got these candles, one right there. These all green candles. We moving upwards, right? We moving upwards. Prices, we are happy. Prices moving towards our target. This is a target line, y'all. Price is moving towards our target. We even get another candle right here, right? Price is moving towards our target. Beautiful, beautiful. We love to see this, right? Then, out of nowhere, you see price start coming down. Literally, this is how it will go. You will get another candle. Price is right here by your take profit line. You almost out of this trade. But before you can even do that, you get another candle where price comes all the way down here. It comes all the way down here, and it takes you out of the trade. Now you're out of the trade. But the candle doesn't close right here. The candle comes down here. It grabs liquidity. It grabs everyone's money, because a lot of people have their setup like this. It grabs liquidity, which is right here at these stop loss. It grabs all of you guys' money, take you all out of your trade, and comes back up. And then hit your take profit line. Just like this. Leaving a long wick to the downside. Right? As we talked. Y'all know we talked about this, right? Hold on. Because price came all the way down here. Price came all the way down there. So we got to show y'all exactly what it would look like if that was the case. Vertical. Right? Ah, shit. Let's see, bro. I'm trying to get right, man. Let me just draw it. I'll draw it. But boom. Right? Before price hit your take profit, it came all the way right here. It left a long wick to the downside. Long wick to the downsides, right? This is price grabbing liquidity. This is what liquidity is, y'all. Pay attention. That's why I broke everything down the way that I broke it down. This is what liquidity is, y'all. This will be where your red line will be, where your stop loss will be, right? This is where your green line will be, where your take profit point will be. But before price even hit your take profit, right, like I told y'all, the only reason it's a long wick to the downside is because before it hit this take profit point, this new candle came in and it came all the way through all of this bearish momentum. Grab liquidity at your stop loss, then came back up and hit this take profit point. Just like that. A lot of the times as you trade, you will see this happen a lot of times, bro. And this does not mean your strategy doesn't work. This does not mean you're not trading right. This is just liquidity, bro. This is literally just market grabbing money so that it can push higher, right? So say now, remember what I told y'all about these long wicks to the downside or to the upside, right? So now price done went up. It grabbed this liquidity. Now that we can see it, it will look similar to this, right? It comes, you know what I'm saying? It comes all the way up, hit that take profit point. Right? But before it could do that, it has to come down and grab this liquidity from these lows, right? It has to come down. This long wick took a lot of people out because their stop losses were right here, right? Their stop losses were probably right here at this time. Their stop losses were probably right here. They think price is going up. Let's say this was their target somewhere right here, right? Before price hit this target, it takes them out. It hits your stop loss. It grabs liquidity. It grabs a lot of money. So liquidity is just money. Whenever the market grabs your money and everyone else's money just to push up higher or just to go lower, whatever the situation may be, right? So that's what liquidity is. Oh, I really hope that shit made sense, bro. I ain't gonna lie. Because I ain't gonna lie. If that don't make sense like that, I don't know how it's gonna make sense. I ain't gonna lie. If this don't make sense, I don't know how it's gonna make sense because it's not something I could literally say like, you know, like it's hard. Like, I don't know, bro. This is the best way I could put it though. right? So liquidity is basically whenever price just grabs these stop loss, grab the money from them stop loss that a lot of people is sitting at, because a lot of people are sitting at these points, y'all. A lot of people's stop loss is right here, right? Because price already broke above these highs, right? So we all thinking to take longs. We all are, right? So for price to hit our stop loss, that is not us doing nothing wrong, because we had a good idea, we assumed good, but the market did whatever it wanted to do. And this does not mean you're wrong, so don't feel like you're wrong. You have to understand in trading, nothing is 100%. And in the market, bro, this market has no feelings, no emotions, bro. So this market is not targeting you because it doesn't like you. The motherfucker don't know you. It don't have no feelings. It's going to continue to move up and down throughout the whole time, bro. So you just have to figure out when to get in and out, bro. And even at these moments, like, you have to understand that liquidity low-key has to be grabbed. Like, it's always going to be some type of liquidity grab. Right here, it's always going to be some type of liquidity grab. So if you know that, you will make it upon yourself to wait for a liquidity grab before you hop into a trade, because you know price will come back to grab liquidity. Price will come back to retest. Price will come back to do these certain different things. So that means you need to wait, bro. That's why we wait on a lot of things sometimes. That's why we wait. In this predicament, specifically, you know, if this was a trading opportunity, price broke above these highs, okay, cool, it's looking like longs. Now what we would want to do is wait for a retest, you know, wait for a little correction, a little pullback, or wait for a price to come grab liquidity, because it's going to do either one, right? We don't want to just hop in because price is moving upwards and it hasn't had any liquidity grab or a correction, right? That's how you fall victim to FOMOing. And FOMO just means fear of missing out, right? So we want to make sure we're trading with the best quality, right? But yeah, so this is kind of what it looked like. This is what a liquidity grab, a liquidity sweep would look like. Price pushes up, but before it can just hit your take profit line, it comes all the way down. It takes you out of the trade, which is a lot of times why we move certain trades to break even, where you entered here and you can move your stop loss to about right here, so that it's a risk-free trade automatically, which is something we have to go in another video. But you know, it's ways around these things, right? But this is why I say it's important for us to wait. And we ain't gonna be too long. I got 15 minutes, but yeah, this is why it's important for us to wait, cause boom, like I told y'all before when I started the video at first, these long wicks to the downside, long wicks to the upside just mean rejection. So wherever the long wick is coming from, that means price is rejecting this area, especially if you have a candle closed, right? So right here, this candle is technically closed. This is a candle closed. It's not moving no more. It's on to the next candle now, right? And it has a long wick to the downside, meaning it was what? If it has a long wick to the downside, what side is it rejecting? Right? If price opened right here, came all the way down here, but didn't close there, it came all the way back and it closed here. What side of the market does that tell you price rejected? The upside or the downside? From this example, where do we think price will go next? Just off of us knowing that long wicks mean rejection, where will we think that price is finna continue to go next? If you said, if you said that means price is going to the upside, you are correct. And you are so smart, because I know that you're paying attention. Now, if you say the downside, comment below things that you are not understanding about my explanation so I can explain it better in other videos, bro. If y'all don't never tell me what you struggling with as far as what I'm explaining, I would never know what I need to fix when I'm making the next video, right? So I hope this made sense to everybody, though. Luckily, all y'all got the answer right. But anywho, boom. Yes, this means it's rejecting the downside. Price is rejecting the downside, meaning it wants to continue to go upwards, right? So a lot of the times we would have these candles like this. It grabs all of this liquidity, comes down, hit stop orders, grab a lot of money just to push price back upwards, right? So when price comes all the way down here, that's not saying that it wants to reverse. And that's another thing, right? It's a lot of FOMO in the market, bro. It's a lot of FOMO in the market, so you don't want to be caught in it, bro. Right? Because look, price comes all the way up here, right? And then price comes right here. Price comes right here, and then he hit people's stop losses. A lot of people, bro. A lot of the people, and you will be surprised. Don't fall victim to this shit, bro. But a lot of the people will see their price hit their stop loss, and immediately after, they'll take a short. They get inside, they'll enter right here where price hit their stop loss, thinking that price is now finna go on a downtrend. Not knowing all it was doing was grabbing liquidity. It's finna come back up. But a lot of people is going to FOMO, fear of missing out, or revenge trade. They just lost a trade, just hit their stop loss. Now they want to get back into the market and make their money back. So what they think now is that price is finna go on a downtrend. They didn't even let this candle close. It's still moving at this point. So they enter a short. They enter a short thinking price is finna go in a downtrend. They're going to put their stop loss at these highs because now price has my stop loss. It should no longer come back up, right? So they'll put their stop loss at these highs. They'll put those take profit probably around these lows right here, right? So as y'all can see, people, what I'm doing though, no matter which direction you're going, we are putting our stop losses at these previous highs. We putting our take profit at these previous lows. Like, we're putting at these certain points. So people, what I'm doing, right? Even though what I'm finna do is basically what a lot of people do that is wrong, but people, what I'm doing as far as these points where I'm lining up my stop loss, it's always at a high. When I'm lining up my target point, it's always at a low or a high. You know, the stop loss is always at a low or a high. It's always at a previous point. So remember that with your points, whenever y'all trying to figure out, like, where is people putting their take profit? Where is people putting their stop losses? It's always at the previous highs or the previous lows, right? So remember that. But aside from that, I ain't gonna lie. Y'all let me know too if I be talking fast, bro. Because I did watch one of my other videos, and I felt like I was talking fast, bro. Not only fast, but loud. So y'all really gotta let me know, bro. Because I'm used to all this shit. I'm just trying to get everybody put on to the basics of trading, bro. But yeah. So a lot of people would have got their stop loss hit, and instead of just waiting to see what price would do, and just being patient, they're going to FOMO, they're going to revenge trade, they're going to hop back in thinking price finna come down, right? They put their stop loss above these highs, they put their new target above these lows, just to shortly see that price will hit your stop loss, right? Because price came right here, you entered again, so now that means price, during this week, price came right here, but it closed up here, meaning price had to come back up, right? Price had to come back up. In order to come back up, it's going to hit this point right here, which is your stop loss, take you out again. It's not coming back down, bro, because that was never the plan of the market. You need to know how to read the market. You need to know what certain stuff mean. It is no way in hell possible that you should be trying to take a short if the candle closure looks like this, or the candle looks like this. I wouldn't even want no shorts in it, because this long way to the downside mean it's rejecting the downside. Yes, it hit your stop loss. Yes, it grabbed your money. That's just market grabbing liquidity so it can move higher. But there's no reason for you to take shorts if you see that it's a big ass candle that has a long way to the downside, rejecting the downside, right? So please remember that, bro. Remember that, right? So they would have got stopped out twice, right? Just cause they want a FOMO revenge trade, right? So boom, a lot of the times price will grab that liquidity, then hit your take profit point after you already got out of the trade, and then after that you will continue to see price moving upwards, right? You'll continue to see price moving upwards. You will continue to see price hit these points. It'll hit another point, which would be right here. And then the next point target will be right here at these wicks, right? Then the next point will be right here at these wicks, right? Right? And the next target will be right here at these, you know what I'm saying? So it just go on and on. And as you can see, it's at this point right here. Every candle is at these highs right here. It is at the next point, bro. Literally, the next point right here is at the next point, bro. So don't make that confused. Don't get confused with these target points. The next point. And right here, the next point. And that's why a lot of the times, again, too, y'all need to grab y'all money, bro. Grab y'all money, bro. For real. Grab y'all money, because if price comes right here, bro, and it starts stalling, gang, get out. Like, literally, people would still stand a trade just to catch this little movement to this take profit. Bro, just get out of the trade, because trying to be greedy and catch that whole move, knowing that it's starting to lose momentum, it's starting to lose volume in the upside, will cause you to be on this liquidity dive right here, right? And will have you mad, bro. So if you know better, just do better. That's all it is to it. If you know better, do better. But as you can see, the example that I had, I don't know why I erased them. But as you can see, a lot of the times price come down, grab that liquidity, and then continues to go higher. As y'all saw me draw those other candles out, it continues to hit these different price points, price targets that we have after it grabs liquidity, right? So if we know that, that's just telling us to wait on them liquidity grabs. Wait for price to grab some type of liquidity, right? And we can actually go over a few examples of what it looks like actually on a chart. Because obviously this is drawing. My drawing ain't that good. So, you know, I want y'all to get the real, like, what it looks like. Because a lot of the times you'll understand on here, but then you get into the market and it's like, bro, what the fuck? So again, after this video, I want everybody to go, you know, on their charts on their phone and look at a lot of the times where price grabbed liquidity and then moved up higher or moved more lower, right? Because it works for both ends of the stick. And this is the actually perfect example, right? This is a perfect example, maybe. Let's see. Did it hit right here? No, I didn't even hit there, so we ain't gonna say that. Let's see who had a good liquidity grab. Nope, it didn't hit there. Price moving downwards. Down. Grab liquidity, upward. I'm not sure if this, I don't know, because boom, price moving downward. So we would have wanted to take shorts on this. So this not even considered grabbing liquidity, because we would have wanted to take shorts this. So this would have been price hitting our take profit point actually. But let's say the upside. Let's say price moving upwards. I guess this can be in a way. Depending on what type of trader you are, though. I want to show some real shit, bro. I ain't gonna lie. I'm trying to show y'all some real. I think ES was the one that had some good examples. ES was the one that had some good examples. Yeah. So even at this time, bro, when you go to your shit and you see a lot of the times these charts, the ones that the whatever you trade in has a lot of liquidity grab. I'm not gonna even say don't trade that, because all you have to do is wait for it to grab liquidity and then hop on a wave, right? If liquidity hasn't been grabbed, I'd be a little skeptical, bro. Because, bro, it's always gonna grab liquidity. I promise you. Like, don't ever think it's not going to grab liquidity, bro. And if you feel like today is not going to grab liquidity, I promise you, the minute you press buy or sell, you are going to be the liquidity. Bro, so just wait, bro. I promise you, bro. You do better waiting, bro, because it's always going to be a liquidity grab. It's always going to be something. Like, if price is moving upwards, it's always going to be one candle that goes all the way low before it goes up higher. If price is moving downwards, it's always going to be one candle that comes high than a bitch before it continues to move lower. So you just got to watch out for this shit, bro. For real. But, boom, let's say price moving up. Price moving upwards. And then, let's see. Price broke above these highs. Let's see a good liquidity grab, y'all. I'm trying to catch these bitches before we end the video. Bear with me. I'm trying to get y'all the best example. I ain't gonna lie. So it can make the most sense. Okay. Let's see. Price came down for the correction, broke back up. Okay, this could be a perfect example right here. Boom. Let's just say we're gonna use this example. I'm not saying I would have took this trade, but as far as liquidity, because that's what this video is about, liquidity, and I want y'all to understand what liquidity is when price comes and grab liquidity just to move up higher or just to move up lower, right? But price closed now, so we can't even see what it's gonna do. But this can be a good example, right? So let's just say we took a long position. We said price is going up. We seen previously price was going up. It had a pullback, which is right here, came back down. So we will probably think it's a retest or a correction. Price just coming down, you know, whatever, right? Price coming down. And even then, this will be a situation of a liquidity grab as well. Because, boom, say you are in the longs. Well, you probably would have hit your take profit by the end. But I say that because you see how this candle comes down literally at the top of this high type shit. So a lot of people, they have their stop losses above this high, especially if price is moving upwards, right? But it would have definitely hit your you would have hit your take profit by the end. Like similar to this. Say you enter around here. All right, let's say if you entered around here and you tried to make your target over here at these highs. You tried to be greedy as fuck. Let's say you put your shit right here at these highs, right? So, boom, you entered right here and price came almost to your shit, bro. Almost came to your take profit, right? Almost hit your take profit, but before it could do that, you know it got to grab his money. So that bitch came all the way down, hit your stop loss, right? Just to maybe come back up. It may come back up, you know, depending on how it is. Market is closed, so we can't say it started losing volume. But this is just an example, bro. Like you're into a trade, price to almost hit your stop loss. Almost hit your target, and then come hit your stop loss just to come back up and hit your target. That is the most annoying thing. But you can watch out for it, because if that was the situation where price came back down here and then say from here it continued to move upwards, right? What we could have did is wait for this liquidity grab instead of just hopping in on this trade on his wave because it's moving up. We could have waited to see when price grab that money. All right, now I see price grab this money. Now let's see if price want to continue to the upside. Let's see if he could break structure to the upside. Right, so this will probably be some 5-minute highs. Let's see. Scroll down. Right. Price grab liquidity right here. I'm sorry. Price will basically, what was that? Where's the liquidity grab? Price grab liquidity right here. Price grab liquidity right here. Right. You could have waited for price to break back above this candle. Right, because this will be some type of low. That's why some type of high right here. This will be some type of high on some time frame. Shit, 5 minutes. Let's see. Damn, I hate when I'm showing examples and the examples don't want to be perfect for me. Like, damn, bro, I'm trying to teach some people and shit. You gotta be perfect, man. But nah. This not showing the way I wanted y'all to see it, but in this situation, you could have waited, right? Or you could have hopped in your trade and get the fuck out. Like, literally, that's why I'm an in and out trader. I'm not gonna lie. Like, it's rare for me to hold trades all the way through because I'm used to how market moves, bro. I will grab my money, get out, and get back in if another opportunity presents itself. And that's how I stay safe in these trades, bro. I don't want to stay in a trade and I make a lot of money just for price to reverse last minute and hit my stop loss. Like, that's where your emotions kick in. Yeah, this is an emotion game for real. You gotta really have real life self-discipline, and you can't have your emotions, and you gotta be able to follow your plans and your rules that you set for yourself before you enter that trade, and you gotta genuinely follow them inside of the trade, bro. Every time you don't follow your rules, you lose for that shit. And if you don't lose today, you will tomorrow. And losses don't always mean, like, bro, losses is the feeling you get. Like, I ain't like, this is a real emotional game. Like, it's a real spiritual, emotional psychology game. Like, trading ain't the hard part, bro. Trading is not the hard part. I promise you. It's the thoughts. But anywho, yeah. So boom. A lot of times what you could have did is wait for price to grab this liquidity, broke back above some type of level, which could have been right here at this candle right here. You see price broke above. Okay, now it's time to enter, get back in the trade, and price could have went upwards, but as you can see, that bitch came right back down. So this could have just been a day of a bad price action. Like I said, I would have never traded right here, but this is just an example of liquidity, right? Of when you enter and you have a target, and before price gets to your target, it comes back down and hit your stop loss. This is price grabbing money. Liquidity is just whenever price comes and grab money, right? Liquidity is resting above highs and lows, right? Because liquidity is resting at the same spot our stop loss is at, and at the same spot our take profit is at. That is where liquidity is lying, right? So a lot of the times you want to make sure price grab that money before I hop in. At least me, I want to make sure price grab his money before I hop in, so that now it grab his money and then it have a long week to the downside. So now I know you want to go back up. So now I could be on the way. I want to be with the liquidity. I want to be with the liquidity. I don't want to get liquidity swept. I want to be with the liquidity. You know what I'm saying? So now we can go back up together after you didn't hit this, you hit this key level that a lot of stop losses was at. Now we can go back up to the upside, right? So yeah, liquidity is just when liquidity is under lows and above highs. Liquidity is basically just resting orders, bro. Right? So I'm gonna explain it like this because I feel like this is the best way to learn it, bro. This is the best way to learn it for real. Let's see if we could get us another example though. All right, that was an example of a liquidity sweep, liquidity grab, whatever you want to call it. Whenever price grab that liquidity before it goes down. Right? Now, let's say in the same situation, boom. Let's say price moving upwards. I can take this green line off now. Again, these examples are not examples of what I would trade. Because none of the things I explained is something I would have hopped in on. Like, it would have been a setup for me. This is simply to explain to you guys what liquidity is and what it will look like on a chart, right? So over this weekend, I want all of y'all to go on y'all charts and point out to y'allself at least 5 to 10 liquidity grabs, liquidity sweeps, and then price go back in the direction that it was supposed to, right? Or just show whenever it grabbed that liquidity, it obviously grabbed liquidity, and you can see it grabbing liquidity. And yeah, just so y'all can get in the groove of it, man. You know what I'm saying? But anyhow, boom. Say price is moving ups. Say price is moving upwards, right? We get a little pullback, right? Now, it's a lot of people. Mind you, this is on the hourly time frame. So if we go down to this smaller time frame, let's see. Like, let's say 15 minutes. Boom. This is what it would look like, right? This is what the pull down would look like. So a lot of people who, just a lot of people. We're going to say a lot of people. A lot of people will see this pullback and want to hop in. Mind you, they'll hop in once the pullback. Bro, it's a lot of people who hop in on this sale, when the price gets right here. Like, gang, you can't do that. Like, if you was to hop in, you want to hop in when price breaks structure to the downside, right? We get a candle closure below these lows, right? Boom, I would have hopped in if that was the case. Whenever I get a candle closure below these lows, because now price showing us that it don't want to go back up anymore. It's breaking lows, and in the uptrend, it's higher highs and higher lows. So it's no reason it should be a lower low. But yeah. Boom, price closed below this candle. A lot of people would have hopped in. Me, if I was to hop in, I would have hopped in at this moment. But a lot of people hop in right here. It's already over, bro. But boom, example. So price came back. It had a little pull down right here. A lot of people would have been like, ooh, sell. It's time to take shorts. It's finna go down. Cool. Boom, let's take a short. Right here. We would have took the short, right? I'm telling you, a lot of people would have took it right here, bro. A lot of people would have took it right here. Boom. They'd have put their stop losses above these highs. And their take profit will be like at these lows right here, right? Boom, at these lows. This is a perfect example. Boom. Y'all tell me what y'all see. I ain't gonna lie. If this don't explain liquidity, bro, I don't know what will. I ain't gonna lie. If this don't If this don't explain liquidity, bro, I don't know what will, bro. I don't know what will. Yeah, we finna wrap this up, but yes, bro, if this don't explain liquidity, then I don't know what will. Like, this is probably the perfect example of what I was trying to get to y'all as far as these liquidity grabs, liquidity sweep, when price grabs money before it moves in the direction that it's originally supposed to move in, right? Before it can hit your take profit, it want to hit your stop loss. That is what liquidity is. Simple. Keep it that simple. If you keep it that simple, bro, you will understand it. Don't try to add all the extra shit, bro. When people add all this extra shit, that's when shit get complicated and hard, bro. Just keep it simple, bro. Keep it simple as possible. Boom. Yeah, so we entered right here thinking price gonna continue to go down. And it did. But what happened? Before price could go down, it hit our stop loss. A lot of people have their stop loss and take profit set up just like this, bro. A lot of people. Mind you, this is a $1 trillion company. So when it hit y'all stop loss, it's grabbing hella money. Like hella money. Hella money, right? It's grabbing hella money. Right? It grabbed all y'all money just to push down lower and it continue to go. Right? So we literally use all the money from y'all stop loss as the engine to go down with more power. So watch out for these liquidity grabs. And the way you could have avoided this is wait for that liquidity grab, right? Now, say if we waited for this liquidity grab, boom, price coming down, but I'm gonna wait and see what's my, see what market is giving me. Because it had a pullback, but this on the hourly, so it could be just a little pullback, probably come back up, right? So we wait. We wait, and we get a liquidity grab. Liquidity grab above these highs. When price come grab that liquidity above these highs, and it's a long wick to the upside, meaning what? Rejection to the upside. So now, I will have a thought or a good assumption that price is now ready to reverse and go downwards. It just grabbed liquidity above these highs, which is a lot of orders is resting above this point. A lot of orders is right here above these highs. A lot of stop losses, a lot of whatever is above these highs. So me as a trader, I see that price came above these highs, grabbed that liquidity. Now I would have went to a smaller time frame and waited for price to show me that it wanted to continue to go downwards, right? So at that point, I will come right here, or we're going to stay on the hourly just because it looks perfect right here. So at this point, we will see price grab that liquidity above these highs. And then we will see price, let's see, it closed below these lows because that's what I would have gone off of. I see it close below these lows. Perfect. Let me hop in on a short. It's going down now. It didn't went below these lows. We're going to enter right here. Right? We're going to enter right here. Now we have our stop loss at these highs that the liquidity grab was at. And we have our take profit at these lows. Now that we are moving downwards. And as you can see, you would have hit the same direction, the same thought, the same assumption, just different timing. Trading is all about timing, bro. Literally, it's all about your execution time when you hop into that trade, bro. You can't rush. You have to be patient because we know that price is going to grab liquidity. We know that prices will come up just to come back down. So if you notice, bro, listen to yourself. Like, listen to yourself and wait, bro. Be patient, bro, because we know these things. And if you know better, do better. You know what I'm saying? So this way, bro, I hope this really stood out to y'all and y'all understand this way because this is the best way I'm able to explain liquidity. And yeah, this is what it would look like. This is what it would look like. And as you can see, price would have hit your stop loss just by you being patient. Price would have hit your take profit. I'm sorry. Just by you being patient, and it could have kept going, literally, because it came all the way down here. So just be patient, bro. Wait for them liquidity grabs. Wait for little pullbacks. See what the market is giving you. Don't rush into it because one thing for sure, the market will give you another opportunity, bro. If it's not today, it will be tomorrow. If it's not tomorrow, it will be the next day. So don't rush the success, bro, because again, this is a $1 trillion company, gang. It's not going nowhere. It's a $1 trillion operation. It's not going nowhere. So you don't have to rush it, bro. Just be patient and take your trades at the right time. But yeah, we're gonna wrap up this video for today. Tomorrow, I think I'm gonna do like another preview on liquidity just for the people who may not understand. And please, if you do not understand this, bro, comment below questions. So in the next video, I got y'all questions already, and I could just like preview the questions that y'all ask me. and we could talk about that before we go into the next topic. But the next topic is going to be about fair value gaps, and I'm not sure. I'm gonna make something up, but yeah, we probably gonna talk about fair value gaps next. Anything that y'all need to ask, let me know in the comments below. I hope y'all enjoyed this video. I hope y'all understood liquidity from this video. This is the best way I can explain it. Make sure you watch out for liquidity. You don't want to be liquidity. We want to be with the liquidity. Grab the liquidity and get up out of there, right? So we want to be on the move downwards. We don't want to be caught right here. So you get caught right here when you're rushing. You get caught right here when you FOMOing, fear of missing out, right? You get caught right here when you be patient and you stick to your plan, stick to your rules, right? So stick to your rules, have that self-discipline, and you'll be all right, man. But that's enough for this video. I hope y'all understood, and I hope this is a good video, man. Y'all have a good rest of y'all weekend. We back with the trading after MLK Day, man.